Hi, this is Daniel. You're watching Unrivaled Investing, a no-hype mission-focused channel trying to find you exceptional companies and unrivaled investments. Today we're looking at Bill Ackman's SPAC, PSTH Stock, which is rumored to merge with Universal Music Group. Let's jump right in. So as we look at it, once again, it's in talks to merge with Universal Music Public or Universal Music Group. And so this is speculation at this point. It's not officially announced. When it is officially announced, if I get enough likes on this video, I will do a deeper dive based on the company presentation. That said, we do have some detail on Universal Music Group because it's part of Vivendi. It's majority owned by Vivendi. Vivendi's public. They sold a stake to Tencent for a lofty $38 billion valuation at the end of the last year. Vivendi already announced that they were planning to take Universal Music Group or UMG public a few years. They said 2023. They accelerated that to 2021. So this could, the odds of that this is indeed the case where Bill Ackman SPAC is looking to merge with Universal Music, trying to take Universal Music public, this could actually be the case. Like the stars sort of do seem to be lining up. Now, it is worth understanding, before, getting too hyped up about it, is that deliberations are ongoing, and the talks could still fall apart. So this has been something that, at least based on a recent, Bill Ackman interview, these talks have been going on for a long time. And personally, if I hear that they've been sort of interested in a deal and it's been going on for months, it does make me a little bit concerned that they might be sort of splitting hairs. Like, hey, this deal doesn't just quite cut it, so you might have to try to find ways to juice it to meet the returns that you want. And so that is a little bit alarming to hear that Bill Ackman has been interested in this for months, but hasn't really been able to get there across the finish line, especially when you juxtapose that with some of the Warren Buffett famous deals where he just sort of figures it out over a weekend and just talks to the founder, and it's like, boom, let's make it happen. So hearing that this could take months of due diligence to sort of figure out that it's worth pulling the trigger does make me a little uneasy about it. That said, let's go back to understanding exactly what's going on. Once again, we're looking at Bill Ackman's SPAC, PSTH Stock, or Pershing Square Tontine Holdings, raised this mega SPAC, $4 billion last year. Keep in mind, the NAV for the SPAC is $20, so double what you normally see for a SPAC. So $20 a share. And so when you see it, trading at $25 a share, that is a nice premium to the $20 NAV. Now, the market was not enthused based on this rumored deal as the speculation sort of started happening. The articles started happening after the market closed, quickly dropped 10-20%, because I think the market was just pumped to think that, hey, maybe Bill Ackman was going to be finding a hyper growth company like Stripe. Alas, it's not. Stripe is not in the cards, at least at what it looks like for now. It's a higher probability, I would say, that this sort of rumor does follow through with Universal Music Group. And so what's that mean? What is Universal Music Group? So they're a leader in the global music industry, 7.4 billion euros in revenue, 1.3 billion in EBIT, or EBITDA, so not EBITDA, it's effectively EBITDA, it's very similar. They're a leader in the global music industry, and they've benefited recently from subscription streaming. This was offsetting the hard goods sales that have been declining for years, CD sales that have been declining, album sales, CDs that were declining for years. Go back to 2000, you're looking at LimeWire and Napster, where effectively illegal music download just was wrecking the industry. And the reality is, people are willing to pay a few bucks for it, or they're willing to stream it through a streaming subscription service like Shopify or YouTube Premium Music or what have you. And so you look at this, and I'm looking at it, and they're saying, look, it's the subscription streaming that's really growing this, at least recently. And you want to look at their business. And so they say 6 consecutive years of growth. Now, keep in mind, this is even though there's been no official public deal announced. Once again, I'm able to look at this financials because Vivendi is publicly traded, and Vivendi owns a majority of UMG. And so UMG, they've grown for the last 6 years. It's about representing international artists of all genres, from the Beatles, the Rolling Stones, Andre Bocelli, Lady Gaga, Taylor Swift. You talk about Post Malone. I'm personally more of a fan of John Malone. I think what he does is pretty incredible. And so you look at this business, and it's The recorded music business is dedicated to the discovery and development of artists, marketing and promoting their music across a wide array of formats and platforms. They're also expanding into other areas like live events, sponsoring film and television recording, and podcasts. This segment, as we'll talk about in a second, this is the one you want to pay attention to because it's the vast majority of their revenue and profits. There are other segments are much they're much smaller, around 20%, or music publishing, which, it's about the discovery and development of songwriters, where they own and administer the copyright for musical compositions, and so dealing with the rights to that, such as being used in films and advertisements. And the last bit is merchandising, where you're selling, goods tied to the specific artists, and that business is a little bit more hit and miss. And so looking at these individual segments, based on the data that's publicly available for Universal Music Group, you see that about 80% plus of their profits come from this recorded music group representing the individual artists. And so this is the segment to follow. 80%, or a little over, or around 20% operating profit, 5.9 billion euros in revenue. You can see how that compares versus music publishing and merchandising. And it's pretty low. It's not crazy growth. It's better than GDP growth, but it's not hyper growth. And I think that's the reason why investors were originally disappointed, where you can see their revenue, from 4.8 billion euros to around, 6 billion euros. So about cumulative 24% growth over the last 2 years. But most of that was from 2018 to 2019, where 2019 to 2020 was around 4%, which isn't super compelling. And then you fast forward to today, or the first quarter of 2021, and you see that their revenue only grew by 2%. So it's not necessarily a hyper growth business. This might be, growing around GDP, maybe double GDP. And honestly, a lot depends on the information that's going to get revealed, as if this deal goes through a proxy statement, through a registration statement, through a presentation where you can get better detail on like, oh, okay, maybe there's a better growth driver, maybe subscriptions driving this and it's offsetting another element, or maybe, not being able to do live events, it really held them back and they could have been 10% growth if there were actually live events going on. And so what about valuation? And just, a quick plug, if you will. So once again, if this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. My goal is to try to find potential multi-baggers, types of stocks that potentially go up hundreds or even thousands of percent over time. So if you enjoy learning about those types of company, please make a point of subscribing. If you're already a subscriber, I do appreciate that thumbs up. And if you want to follow my personal journey as I look for these companies, go to unrivaledinvesting.com, click on Journey. First week of the month, I call out my full portfolio. Then once a month, I try at least once a month to call out potential multi-baggers or types of stocks that I think have that type of potential upside. And we're also building out an exclusive, a dedicated community of like-minded investors that like to think about this. And there's also exclusive content that you can see in the link below. So that's enough about me. Let's get back to Bill Ackman's deal, PSTH SPAC, where you look at it and once again, before getting too excited about the valuation, what price it is, recognize that talks are ongoing and they could still fall apart. Heck, this gets to the point that Bill Ackman has been talking about this deal for some time, or has been working on this deal for some time. It does make me concerned that it wasn't a super fast deal, super compelling, or that he couldn't pull the trigger super fast. So this is a hypothetical exercise that we're doing based on the rumored figures from these various different news articles, like a $40 billion valuation. But we do have the financials for Universal Music Group, if that indeed is the acquisition. And so looking at it, looking at a $40 billion rumored valuation, plus you got to factor in whatever premium that PSTH currently trades above NAV. I'm putting 20% here. So that would imply about a $48 billion valuation for Universal Music Group. Convert that to euros, because historically their financials were in euros. That gets to around 40 billion euro valuation, based on the premium of the SPAC, PSTH SPAC. And so look at the revenue. So 7.1 billion in revenue in 2019, 7.4 billion in 2020, so about 4% growth. Once again, 2% growth in the first quarter 21, so not crazy, hyper compelling. So I'm assuming a range of 0 to 5% growth this next year. I think a lot of this thesis that Bill Ackman's considering here, and part of the reason why maybe he's taking so long, is that he's thinking about how much could margins be in the future. And he's thinking, if I could double margins and get 5 to 10% growth, then I will have a home run investment. And that, I think, probably is the crux of the thesis. That said, I haven't seen enough data at this point to really conclusively say, oh yes, margins should definitely be higher. I haven't heard that thesis, seen the data. If he calls it out saying, hey, we've done a zero-based budgeting analysis coming to the conclusion that margins can be 30 to 40%, then you start getting a little bit more excited about this thesis. Currently, they're operating around 20% operating margins, around 20% tax rate. And so, you take that and you look at what the implied earnings multiple are for, is potentially for that deal. And so effectively you're getting high 20s to let's say mid 40s for this deal, which isn't crazy compelling given the low growth profile. But once again, if Bill Ackman either sees subsegment growth that might overtake the rest of the business and start resulting in a cumulative consolidated revenue growth that's better than what they're currently posting, maybe that's it. Maybe, maybe they're just looking at the private equity angle of, hey, can we get margins much higher? And so, looking out over a 5-year investment time horizon, I'm assuming over, beyond 2021, a growth rate of, let's say, 5 to 12.5%. I personally don't see the data here to get this high side of 30% margins and 12.5% growth, annualized growth. Maybe Bill Ackman sees that. And, I'm assuming an N multiple of, let's say, 20 to 30 times. I wouldn't ordinarily give 20 times for a business that's only growing at 5%, but there might be an element here. I think I'm giving them more than a benefit of the doubt. So this is a hypothetical, valuation range. I think I'm giving sort of an aggressive range here, aggressively high, because 20 times for 5% growth just doesn't cut it unless it's sort of a pride of ownership asset. And they might be that, hey, largest music group, hey, who, you can effectively, you're working with Lady Gaga here. How cool is that? And so there might be an element here where you get that premium multiple because of it. For me, investing isn't about pride of ownership. It's about finding those potential multi-baggers. And so I'm not compelled by that type of valuation. And so just plugging in these figures, into thinking about it, I'm getting like downside of about 50%, maybe more, if people, aren't super pumped about low single digit type of growth rates, and, upside of less than 100%. So I'm just not compelled by this, not surprised to see the market sort of react negatively to this. If you have a different take, I'd absolutely love to hear it. And look, in my opinion, when I'm considering investing, I would much rather either own something that's, in my opinion, obvious, like in my May potential multi-bagger for Unrivaled Investing Journey subscribers, I call out a company that's trading below liquidation value, and where I'm like, hey, this has 2 to 3x% up, or 2 to 3x upside. So that type of risk reward is way more compelling versus a SPAC that trades at, let's say, 20% above cash. I would personally rather invest in SPACs trading at cash or below cash with solid sponsors that I have high degree of confidence they'll find a reasonable or even above average deal. So that's my personal take. I'm not really sold on this deal. If there's a different angle that you see looking at Universal Music Group, I'd definitely love to hear it. Leave a comment below. If this is your first time tuning in, please make a point of subscribing. If you're already a subscriber, I do appreciate that thumbs up. Thanks so much for watching.